Every single time there is bullish momentum in any market, 9 times out of 10, it is always fueled by some kind of narrative. All right. So in this video, we're going to be going over a narrative trading opportunity / yield farming strategy on a Bitcoin layer 2 called Stacks on the decentralized exchange in Alex. So before I get started, I do have to say this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like we always say, do your own research, but use this channel as a starting point. So in this video, we're going to briefly cover what problems Stacks is solving. We're going to cover why this narrative trading opportunity makes sense right now, and we're going to go through Alex's docs. We're going to look at their tokenomics, and at the end, I'm going to do a platform walkthrough, and then I'm going to tell you if I would use the platform or not and why. So without further ado, let's get into the content. So if you watch my last 3 videos on my take profit and yield farming strategy for optimism, arbitrum, and matic, I kind of described the problem with layer 2. So I'll briefly touch on the problems that layer 2s are solving. So I'll briefly touch on it here, but if you want more details, feel free to watch those videos. So any blockchain, including Bitcoin, because this video is about Bitcoin basically, any blockchain has an issue called the blockchain trilemma. So you have security, decentralization, and scalability. Pick 2. Each blockchain is optimized for 2. However, there are things being done so that each 3 are optimized. Bitcoin is famously optimized for their security and their decentralization, but their transactions per second is extremely slow as they can only handle 7 transactions per second. So on any blockchain, there are 3 components. You have the consensus layer that says what's true, and this is done by the consensus mechanism on Bitcoin, that's proof of work. You have the data layer, which is like you hear about these parallel shards that run next to the blockchain. It's essentially storage, so everything can be stored, all the data in each block. And then you have execution, which is like your computational finality, transactions actually being processed. And this is what layer 2s are designed to help with. Right now, all 3 of those different components, consensus, data, and execution, are happening on the mainnet, and any blockchain is in the business of selling blocks. There's only so much space in each block. So when you have, like in the bull market, more people bidding on the same number of blocks, gas fees go up. That's why you've heard about people complaining about Ethereum gas fees, Bitcoin gas fees, or the transactions are kind of slow down. It's just like if you're trying to buy a plane ticket from San Francisco to New York. If it's only one plane, those tickets are going to be extremely expensive. But if you have multiple planes, the price goes down with each available plane. So layer 2s are created so that the execution can happen on the layer 2, and then they roll it up. That's why you hear about these optimistic rollups and ZK rollups. They roll up the transactions and they compress them. Just like when you get a compressed email, the data is smaller. When you compress something, it makes the data smaller, so then they can submit it to the layer 1 in Bitcoin and still get the security from the consensus mechanism. But it frees up a lot of block space, which leads to cheaper fees, faster transactions, and just overall increased scalability. So living here in San Francisco, man, you'd be surprised at what people think the real Bitcoin is. Some people think it's Bitcoin SV, Bitcoin Satoshi Vision. Some people think the real Bitcoin is Bitcoin Cash. And when I say real Bitcoin, what I mean is like the Bitcoin that's going to be adopted mainstream. People are really delusional here, but there may be some truth in the whole narrative of DeFi going on Bitcoin, because you have people building layer 2s, you have the Lightning Network, you have Jack Dorsey changed Square to Block, and they're building out like a lot of different Bitcoin products. So, hey man, if people are building and people are using it, who am I to say that it isn't going to work? So like I said in the beginning of the video, Stacks is pretty much the main layer 2 built on Bitcoin. They allow you to have smart contracts on the layer 2 so that you can have smart contracts on Bitcoin because, and we're going to get into this later, Bitcoin's mainnet isn't optimized for smart contracts to be built on top of them, as it's not Turing complete. Then also, why is an investment into Stacks or an investment into Alex, which is what we're going to be predominantly talking about, why does this make sense right now? Well, the narrative is the Blackrock ETF. If this Blackrock ETF is approved, it's going to cause a lot of buying in Bitcoin. And given that it's a Bitcoin layer 2, you have a lot of retail investors investing into these layer 2s because they think it's going to pump when the Blackrock ETF gets approved. I'm not sure if it's going to happen in January. The deadline for the SEC to approve the ETFs is January 10th. So that's 6 days from now. I'm recording this on January 4th. You'll probably watch it on January 5th on Friday when I release it. But even if the ETF doesn't get approved, it may not be a bad idea to make an investment into one of these protocols. And as it continues to pump, just take your profits. And you don't even have to wait to see if the ETF gets approved. So let's head over to DeFi Llama and look at some statistics. All right, so here we are on DeFi Llama. You click chains here, and let's find Stacks. All right, so Stacks is number 41 in terms of TVL. Let's go ahead and click on it. You can see right now they have a total value locked of $60 million. This recently spiked, and I'm pretty sure it has a lot to do with the Bitcoin ETF. Like I said, it's a narrative trading opportunity. So pretty much on November 24th, things started to go exponential. All right, and before that, they were at a TVL of just $19 million. So it really started to skyrocket here. And if you look at the protocols built on Stacks right now, it's only 6, but the number 1 protocol on Stacks is AVAX, the decentralized exchange that we're covering. So now you may be thinking like, okay, if it's a narrative trading opportunity, what about the other 6 protocols? Why is a decentralized exchange, other than the fact that it's number 1 in TVL on Stacks, why is it the best move to invest into a decentralized exchange? Well, to reference that, we're going to visit the Coinbase Master Plan essay that was written by Brian Armstrong, because what you have to look at is that every time there's a new ecosystem, there is a stack at which things are built, and you kind of just invest with the stack in order, because it's kind of the adoption cycle, and you guys will see what I mean here. All right, so this was written September 7th, 2016, or at least published. And basically, Brian Armstrong lays out the adoption cycle for new technologies, and he compared the internet with blockchain technology. So in phase 1 for the internet, you have the protocol, which is TCP/IP, which stands for Transmission Control Protocol, Internet Protocol, and it's essentially the standard. They call it the client-server model. It's the standard that allowed all of these protocols to talk to each other, regardless of what programming language you built your database or systems with. They can all talk to each other. So like imagine back in the day you had a Hotmail, I had a AOL. If it wasn't for TCP/IP, I wouldn't be able to email you because we're using 2 different email standards. So TCP/IP allowed these different protocols to talk to each other. So after you had the protocol, then you needed infrastructure, and then you have internet service providers lay fiber optic cables. So you had people who set up businesses to allow you to pretty much get on the internet, just like you have businesses that allow you to get on chain that we're going to talk about. After that, you have the actual browser, Mozilla Firefox, Internet Explorer, Safari. Lastly, after that, you had actual applications. So for Web 2.0, that's things like Facebook, Instagram, Snapchat, anything that's a website, that's an application that you can go on there and interact. So for crypto is kind of going through those same exact phases. The first phase was the protocol phase. So a Bitcoin is a protocol. Bitcoin is an asset, a network, and a protocol, but nonetheless, it is a protocol. And also talked about the reach. So the first phase, you had 1 million people coming on to the internet and to blockchains. The next phase in infrastructure, you have exchanges and secure storage. Now, these exchanges also apply to decentralized exchanges, and now you're probably catching my drift here. So after you have the protocol, which is Stacks, the Bitcoin layer 2, now you need actual exchanges so that people can have an on and off ramp to essentially come on. It's like if you're building a building, you have to build up the foundation, which is the protocol, but then you have to put doors on it so people can go in and out. If there aren't any doors, people aren't going to just like go up and climb through the window. That's too hard. Phase 3 is the user control wallet, which is already there. So now you can store your assets in there, interact with these different protocols. And then the last phase is actual applications. A decentralized exchange is technically an application, so it can go in either of these, but you have other applications being built on these layer 2s, and that's the whole idea of DeFi behind Bitcoin. All right, so now that we went through that, let's start going through Alex's docs so that we can kind of learn about their features and then ultimately show you guys how you can get a yield on some blue chip assets. All right, so here we are back on DeFi Llama. You hit Alex. Like I said, it's the number 1 protocol on Stacks. You can see they have a $45 million TVL, and this pretty much increased around the same time that the Stacks TVL increased, around November 24th. Started to go parabolic. So now let's take a look at their docs. So it says, what is Alex? They believe that Bitcoin DeFi, like we talked about in the beginning, is set to take center stage. In the coming years, we expect a surge in growth revolving around ordinals, which are pretty much like think CryptoPunks on Bitcoin, BRC20 tokens, which is like ERC20 tokens, which is like the standard for fungible tokens on Bitcoin, and then Bitcoin layer 2s in particular stacks, the one we're talking about here. So they're saying, in essence, Alex is a concentrated bet on their belief of Bitcoin DeFi on Bitcoin, basically. All right, so let's look at the design here. So it says Alex allows for implementation of arbitrary trading strategies, and Borrows is designed for Balancer V2. And guys, just so you know, it seems like most of this stuff isn't live yet. Like you can go on there and make swaps, but in terms of like borrowing and like this collateral rebalancing pool that we're going to talk about, I don't think these things are live yet. So let's just go through a few of these here. So it says equation abstracts rebalancing and market making logic, while pool encapsulates the value of a strategy. Pool abstraction allows aggregation of the assets of all Alex pools into a single vault, meaning bringing many advantages over traditional DEX architecture. So Uniswap v4 is kind of doing this structure too, where they have what's called the singleton contract. And instead of having a bunch of separate liquidity pools, they're bringing everything under one liquidity pool so that it saves on transaction fees. And the reason why is because like if you want to trade some odd pair, like let's say Chainlink to Gala, you know, it's not just going to go from Chainlink to Gala because that's not a popular pool. It's probably going to go from Link to Wrapped ETH to ETH, then from ETH to Gala. And you having to pay a gas fee anytime any of those are swapped. But if it's just one swap, it's kind of like an OTC, like buying Bitcoin OTC. It doesn't actually have to move on chain. So the equation triggers pool rebalancing. This allows creation of any arbitrary rebalancing strategies to be deployed as a pool. Also, it's important to note that they don't have concentrated liquidity, meaning you can't pick a price range for your liquidity to be used. You're using it from X and Y, which makes your capital more inefficient, but it also lowers your impermanent loss risk. So, you know, there's always a trade-off, so it's good to keep that in mind. Then they have their collateral rebalancing pool, and this uses weighted equation and dynamically rebalance between token and collateral. CRP dynamically rebalances collateral to ensure the AY token minted, i.e. the loan, remains solvent, especially in an adverse market environment, i.e. the value of the loan does not exceed the value of collateral. So basically it seems like they'll let you go and take out a loan and then use that to farm with, but they'll manage your collateral and your LTV so that you don't get liquidated. But like I said, that is not live yet on their site. And if you click collateral rebalancing pool, it gives you all the details on that. It gives you an example as to, you know, how they would solve the liquidation problem. It seems like I'll let you guys run through all that. I'm not going to bore you with all those details. And they have the same thing with the yield token pool, the lending, borrowing, and assets. And they say you can refer to their white paper for pretty much more details. Also, I wanted to go back to what is Alex. I wanted to cover something that was super important that'll help give you guys a framework to think about these layer 1s and layer 2s, especially for Bitcoin. So it says, our vision at Alex is to dissolve the barrier between Bitcoin layer 1s and layer 2s to create a seamless Bitcoin DeFi experience. The relationship between Bitcoin and stacks is fundamentally different from that of Ethereum and Arbitrum. In the Bitcoin stacks pair, the layer 2 equips the layer 1 with smart contract capabilities, while in the Ethereum Arbitrum duo, both the layer 1 and the layer 2 possess their independent smart contract functionalities. Therefore, a true Bitcoin DeFi experience isn't about users having to choose between layer 1 and layer 2. Instead, it's about Bitcoin asset holders experiencing DeFi on layer 1, with layer 2s running smart contracts unobtrusively in the background. Okay, so guys, just to translate that, they're basically saying that, you know, you can't, I'm not going to say you can't, but it's not efficient to build smart contracts on the Bitcoin layer 1, so they're building them on the layer 2, whereas Ethereum, you have smart contracts built on Ethereum and on all the layer 2s, Polygon, Optimism, Arbitrum, all of the Ethereum layer 2s. And the reason why is because Ethereum is what's called Turing complete, while Bitcoin is not Turing complete. We're going to dive into this right now, but if you guys haven't seen the movie Imitation Game, you should definitely watch it. It's basically a story of the computer, and it really highlights the difference between a calculator and a computer. Alan Turing was hired by the United States to build this computer. The original purpose behind creating the computer was so that we can crack what's called the Enigma, which was the Russian encryption machine, and it's how they communicated through the war. So Alan Turing and his team, they created a Turing complete computer, and it actually helped us win. I think it was World War II. They found out how the Russians were communicating, and then the hard part was keeping the secret so that the Russians didn't know that they found out how they were communicating, and then they were wondering why all of their boats were being destroyed and how we were always one step ahead. All right, so we're on bitstamp.net, and it's a lot of information on the internet around Turing completeness. So it says Turing completeness is a term in computer science that describes the ability of a system to compute any possible calculation or program. It can be used to describe modern programming languages. So it's basically like a calculator can only do one thing. You say what's 1 + 1, it can give you 2. But to be Turing complete is to give your computer more complicated tasks to do. So it says Turing complete describes a programmable system that can solve any computational problem. The concept comes from the Turing machine, a theoretical model of computation devised by Alan Turing. Conversely, a non-Turing complete system is limited to performing particular tasks based on predefined instructions. A common analogy is that a pocket calculator is non-Turing complete because it's only programmed to perform a limited set of mathematical calculations. However, with the home computer, it's possible to write a program that will carry out the same tasks anonymously. So Bitcoin and Ethereum provide the best known contrast for Turing completeness. Bitcoin and its script programming language was designed as a non-Turing complete system with limited functionality. The Bitcoin software was programmed solely to process Bitcoin transactions and cannot support complex, multi-step smart contract logic. However, Ethereum allows developers to write code using the Turing complete Solidity programming language and execute it using the Ethereum virtual machine, or EVM, which is also Turing complete. Theoretically, it's possible to write any program for any use case and run it on Ethereum. So Ethereum was literally the first Turing complete blockchain, and it talks about the limitations to Ethereum's Turing completeness. Basically, I talk about this in a lot of the Radix videos. The Solidity programming language treats everything as a smart contract. So whenever a smart contract is interacting with another smart contract, like every transaction on the chain is a smart contract interacting with another smart contract. And that's why I like Radix, because they have what's called an asset-oriented smart contract programming language, where they put assets in buckets so that if there's a flaw in the smart contract, it doesn't affect the balances in people's wallets. Right? Whenever a smart contract has to communicate with another smart contract, it is a chance for an exploit, as it makes the system vulnerable. And that's why you hear about all these hacks, despite you hearing about projects getting 2, 3, 4, 5, 6 smart contract audits. Radiant just got hacked yesterday, and Gamma Strategies just got hacked today. And these are both protocols that have plenty hacks. So just to wrap it up as a summary here, Turing completeness describes the ability of a system to mathematically compute any possible calculation or program. Ethereum was the first Turing complete blockchain to launch, which marked the moment when potentially limitless smart contract capability became available to everyone. And although Turing complete systems open vast possibilities, programs can also result in anticipated outcomes that may be exploited by malicious actors. So basically, Stacks is built in this layer 2 so they can kind of help Bitcoin be indirectly Turing complete. Now that we covered that, let's get back into the docs and keep going with this platform walkthrough. So it talks about the vault, which holds all the pools. They also plan to offer flash loans, popularized by Aave, which basically allows you to take out a loan pretty much of any amount, just as long as it's paid back within the same block or the whole thing gets canceled. They talk about their bridge. They pretty much have a bridge on the website that allow you to go from EVM compatible chains, I think BNB, as well as a bridge from Bitcoin, which is pretty cool. They also have an order book exchange on their platform, which offers instant trade confirmation to the security of Bitcoin. So it says order book uses a hybrid on and off chain design, whereby a commitment to buy or sell a certain asset is communicated in a cryptographically signed message, which is then matched by an off-chain matching engine before settling on chain. So why do we need order book? Because it brings instant trade confirmation, like we said. and it addresses a key user experience issue our community has on stocks, which is a trade confirmation requires waiting of 10 to 15 minutes. Seems like that would be solved in a liquidity pool versus an order book. In my experience, the liquidity pool is more efficient than order book because you don't have to wait for a buyer to match up the seller. All the funds are just in a pool, and when someone wants to buy, it just the smart contract takes it out and replaces it. But maybe it's something that I'm missing. So it talks about all of the benefits: instant trade confirmation, gas-free orders, security of your assets, etc., etc. Then they also have a launchpad, which is kind of like their own Kickstarter program where projects can go on there and get funding. I'm pretty sure you have to be built on Bitcoin in order to get it. If not, why not just go use the other one? And they have an off-chain lottery system where you can buy tickets and win money. Win Alex, I believe. So now that we went through that, let's go through their tokenomics and see if this is actually a good investment. A lot of times with crypto, you have tokens with inflation and deflation. You need to know if there's more going to be dumped onto the market, etc. So let's cover all the things tokenomics with Alex and determine if it's actually a good investment or not right now. So if we look at Stacks, it's already in the top 50. It's number 41. It's a market cap of 2.4 billion, fully diluted valuation of 3.1 billion. But Stacks isn't what we're considering investing. I feel like it's pretty high. It's already pumped if the ETF gets approved. Even if it goes to $3, you pretty much just doubling your money. It's not really worth the risk for me. However, let's look at Alex. Alex is only number 212 on CoinMarketCap or CoinGecko. And you can see the market cap's only $238 million. That's pretty low. And guess what? The fully diluted valuation is $238 million. So just to give you guys the difference between these two, the market cap takes into account the circulating supply. The fully diluted valuation takes into account the max supply. And the higher the disparity between these two, the worse usually. However, all of these tokens are unlocked. Now, that doesn't mean people aren't holding them still and can still sell, but it's better than them being locked up. People want what they can't have, and a lot of times when tokens are locked up, they have a lot of VC funding. They have a fiduciary responsibility to generate returns for their limited partners, aka their investors. So as soon as they can sell them, they usually do. And let's be honest, people know that the Blackrock ETF is on the horizon, so I feel like people want to make money. So it's probably not a good reason to sell now, unless people want to take profits. Actually, I'm not even going to say that. So we can see the price has been going parabolic. And if we look at the tokenomics, you can see the allocation. So most of it went to the community, 50%. The team got 30%, which is a lot. Private sales was 1%, and the foundation gets 19%, which is kind of also the team. And you can see the supply schedule. All of the tokens were unlocked last year, it looks like here. So that's pretty good. And just being transparent, I don't own any Alex. I don't know if I'm going to buy some, but I just wanted to make this video so that I can give you guys some information just in case you were considering making this investment. I'm not saying you should or you shouldn't, but I just wanted to give you all the data that I can provide so that if you do decide to make a decision to invest, at least you have all the data. And guys, if you like this kind of content, you want to get access to my buy and sell calls that I use for my investors within my hedge fund to generate returns. You want to learn how to yield farm and generate passive income on blue chip assets ahead of this next bull market so you can have more to sell. You want to make sure you learn security so you don't get hacked, master fundamental and technical analysis so you can master your entries and your exits, as well as be able to determine which assets are good to buy. We're getting to a point where crypto's going to be so big that no matter who you are, you're not going to be able to manage all aspects. So while we may miss opportunities, we've got our teeth sunk into what we think are going to be the next narratives in the next bull market. And we like to believe that we're exposing ourselves to the best possible place and creating some strong portfolios. And we love to help you do the same. So if that's something you're interested in, click the link in the description, book a free strategy session with someone on our team at Know It Alls. We're going to ask you a few questions, get to know you, just see where you are on your journey, ultimately to see if this program is a good fit for you. If it's not, we're happy to point you in the right direction and still answer any questions you may have. We want you guys to use this as a resource, as we're just here to help onboard as many people onto crypto and Web3 as we can, and ultimately help people create wealth for their family. Now that we went through the tokenomics and all that stuff, let's finally go through this platform walkthrough. And at the end, I'll tell you if I would use this platform or not and why. All right, so here we are on alexgo.io. It's pretty cool Bitcoin little spinny thingy here. As you see here, it shows all of the products that we have, and it doesn't have like all of the stuff that they were talking about. It just has the swap, the trade, the kickstart, and the connect. Shows you how to get started, ecosystem, kind of breaks down the team. It doesn't like, it says their credentials. Who knows if it's actually telling the truth or not. Like these are some pretty good credentials. Former managing director at Credit Suisse and Morgan Stanley. Former executive director at JP Morgan and Goldman Sachs. Former executive director at Goldman Sachs, JP Morgan, Credit Suisse, head of Asia Equity Structuring. They don't have their LinkedIn or their Twitter or anything like that. And you have the core team, developers, and then you have like some board members here. These are some of their investors. White Star Capital, OKX Ventures. So nothing like super crazy, but it looks pretty good. Oh, and here are their security audits. So they actually did get some smart contract audits. Yeah, and you got like all their Discord, their Twitter, their YouTube. Most projects don't really have YouTube channels. Let's see here. Oh, they have 1,000 subscribers. That's not bad. Yeah, the project seems pretty serious. That's not bad. See how their Twitter looks. 100,000 followers on Twitter, not bad. So yeah, this project seems pretty serious. Marketing is a big thing. All right, let's scroll back up here and enter app. All right, so here's the swap feature, just standard swap. And if you want to connect your wallet, they give you an option to connect like a Stacks wallet, a Bitcoin wallet, as well as an EVM chain wallet and MetaMask. So that's pretty cool. You got your order book here that we talked about. So just like a standard order book DEX here. I have not used this, but I just wanted to break everything down for you guys. You hit market, you can see all the data here. Portfolio, I don't have anything here. I'm not sure what points are. You probably get points every time you use it. And if we go to pool, we can see the yield farming pools that they have here. So if I were to hop on any of these pools, it would probably be Stacks and Bitcoin, or maybe Stacks and Alex, or Alex and Bitcoin. Any of those three. I don't even know what all these other ones are. You have a Stacks BTC pool here. You can get 53% APR, and I'm pretty sure it's factoring in. These are the fees that you get from people actually trading, and this is the fees that you get from staking the liquidity provider or LP token. So these are all the pools. Oh, here's one, 101% APY. I'm not sure what Welsh is. Stable swap is just for stable coins. Not bad, 18% for a stable coin pool. 230K in it though. But nonetheless, still not bad. I see under earn. I think this is like the same exact thing we were just looking at. Gain power. Gain A power to increase your access to IDOs on the Alex Launchpad. The amount of A power received will be money. Not sure what that means exactly. I didn't see that on the docs. Maybe I should have went through the white paper. And you have a staking page where you can like stake your LP tokens or just stake your Alex, it looks like here. And your staking is automatically compounded. So they give you what you would have if you staked here manually versus just letting them compound it, so it outperformed. And then they have their lottery page. You can connect your wallet to buy a lottery ticket, it looks like, and it gives you like the winners. Looks like they're burning Alex on transactions or on a lottery winners, which is good. Supply and demand. If you take in supply off the market, even if demand stays the same, the price has to rise. And then let's check out their bridge. So this is cool. You can go from Bitcoin to, let me see, I have to offer more. Yeah, this is the Bitcoin bridge, the BRC20 bridge, and you got the EVM bridge. So you can go from Binance Smart Chain, or you can go from Ethereum. You can connect your MetaMask here. So they have the on-ramps pretty accessible here. You can check the bridge history. They also have a bug bounty. So if you can find any hacks, they will pay you for it, which is good. So yeah, the project seem pretty serious. All right, guys, now that we went through all the docs, the tokenomics, the platform, everything, would I use this platform or not, and why? To be honest, right now, I wouldn't. Once you've been providing liquidity via concentrated liquidity and you have more control over like what you can do, it's kind of like driving a car with multiple gears and you get back in a car where it's only first and second gear. Maybe that's a bad analogy, but hopefully you guys are catching my drift. I can make way more returns on like wrap Bitcoin and ETH or Bitcoin USDC, or I can get into a higher paying pool and use those funds to buy either Alex or Stacks or Bitcoin or whatever I want. You know, you don't necessarily have to be LPing for the asset that you want to hold, unless it's a better idea if you can get a high paying yield on it, as well as use it for a take profit or buy the dip strategy. And I've made plenty of videos on that. I do like it. You know, if they were to implement concentrated liquidity, some of the features that they were talking about in terms of like allowing you to leverage and you know, them help you not get liquidated while you're still yield farming. You know, as they launch some of the products they were talking about, I would use it, especially with a narrative trading opportunity like this to accumulate some Alex. Will I? I'm not sure, but I'm just giving you guys kind of like my honest take. They have their audits. You know, I do believe that it's possible for more applications to be built on Bitcoin. People love Bitcoin. It is super secure and decentralized. So I don't see why layer 2s on Bitcoin wouldn't be like a serious thing, or at least a narrative for the next bull market at least. So those are my thoughts on it. So with that, I'd like to conclude this video. Hope you guys got some value from it. If you did, consider subscribing, drop a like, comment. Let me know if you have any feedback for me. Constructive criticism is always welcome. Let me know if I missed something. Let me know what you guys want to cover next. But with that, I thank you guys so much for watching. I love every single one of you. And I will see you guys in the next video. Take care.